Hello everyone, this is Peter Towers. Welcome to this webinar. Crowdsource funding for private companies presents opportunities to create new income streams. I hope you're having a great time wherever you are. There's a few people who have still not registered, so we might just wait about a minute and then we'll get started. Crowdsource funding is an exciting area, I think, for the accountancy profession, and obviously it's very exciting for your clients. Because for the first time, they have the opportunity of raising up to $5 million from potential investors. And the investors can be literally anyone. They don't have to be sophisticated investors. So let's get started on this crowdsource funding journey. The journey, first of all, for accountants to become aware of this great opportunity for your clients. Wanted, accountancy firms committed to crowdsource funding. I can nearly see those ads. Crowdsource funding is brand new. No accountancy business in Australia has an historical advantage other than a couple of firms that might have been involved in the first group of crowdsource funding capital raisings that took place when companies had to convert to be an unlisted public company. I understand that only 9 of those capital raisings have been conducted. So for the vast majority of the accountancy industry, this is a brand new industry that no one has an historical advantage. And there's no longer any need for your clients to convert to an unlisted public company. Now is your opportunity. Please don't miss this great opportunity to diversify your services and offer the type of services that your clients are undoubtedly looking for. Who's it targeted at? Small businesses and medium-sized businesses. Inventors. So a startup can apply for this, as can a 90-year-old company. Now, who are these types of businesses the traditional clients of? I think they're the traditional clients of the type of people who are watching this webinar recording. Small to medium-sized accountancy businesses situated throughout Australia. I believe that they're your natural clients. They are not the natural clients of the big 4 accounting firms or the top 20 firms. Please don't encourage them to go somewhere else because you don't offer the services that some of them will now require. This is a great opportunity for you to be able to grow with your clients. So offer them a great service so that they can get underway in raising capital. In so doing, you will create a new income stream. Is the company a potential crowdsource funding company? I'm going to take you through the steps that will assist you to do this. But in the first instance, why not analyze your clients? There are 2 main areas of determination. The first one, which I've called phase 1, is the legal test, which obviously anyone who aspires to be able to raise capital as a crowdsource funding company must be able to achieve. They must pass the legal test. But the second phase is more subjective comments and tests to determine whether the companies are interested. And the key thing is that if you have clients, and I'm sure you will have some, who fall into the phase 2 category, that you are able to offer this service to them without them thinking that you're only interested in doing taxation work, and they go off and talk to someone else. It might be a competitor down the road who also offers taxation service. So who do you think is going to be doing that client's tax return in the following year? Phase 1, let's look at the legal tests. The group turnover or sales must be under $25 million per annum at the time when the crowdsource funding offer document is being presented to the public. And the group asset values must be under $25 million 1 month before the crowdsource funding offer document is presented. The company cannot be listed on a stock exchange, and neither can any associates anywhere in the world. So let's look at the first part of the subjective comments, because they're the legal tests. A company can operate in any type of industry at various times with grants and other initiatives of the federal government. The benefits are restricted to particular industries. This does not apply for crowdsource funding. The company can come from any type of industry, and there's no age specification. So there's no restriction on a startup. There's no requirement for the company to be under 3 years of age. I said earlier, the company could be a startup or it could be 90 years of age. It doesn't matter. So let's look at what we have identified as what we're calling the subjective tests. And it's in this area that I'd be suggesting that you really start thinking about your clients and analysing them to determine who might be interested. And we've categorised these in the first category, category A, business review. A business with a turnover over $2 million that wants to scale up. Someone that wants to grow their business from a $2 to $3 million turnover to be a $5 to $10 million turnover the next couple of years. Now, some people think that's easy. It's not. It's a hard road, and they will need extra capital in the business to fund the work in progress, the inventory investment, and probably more particularly their investment in debtors. And they may have to buy some more plant and equipment and facilities. The client that you have that's thinking about scaling up, can they fund all those things? Or will they need to try to raise some extra money? Where are they going to get that money from? Have they got the required security? How are they going to go dealing with banks in the current climate following the Royal Commission? And it could be a very good apprenticeship for a company that's wanting to scale up to see whether they really like this concept of being a de facto public company, which is what I think they are if they raise capital from the public. Have they got an aspiration later on of doing an IPO, an initial public offer? This might change their mind, of course, when they deal with some external investors as shareholders and one or two other people potentially on their board of directors. And if they raise more than $3 million, they have to deal with auditors. They might rethink an IPO, but it's a great opportunity to do an apprenticeship, a trial run. What about someone that's what's described as an early stage, high growth and disruptive company? Someone that's wanting to reset the world. It might be a new product or process or service, or it might be something else that they've invented. As long as it can stack up and look commercially viable, they could be a great entrant. Business expansion, a company that's been going well, got a good result, and would like to buy similar businesses in other locations. Acquisition of businesses, a bit similar to the one before I met. And do they have a vision for the business? Is there a great vision that's been outlined by the CEO and the management team? So does the company require funding to implement these visions, to take them on this journey? Section B, we've called succession planning. When I was practicing accountant, I come across quite a number of clients who used to say to me when superannuation was first becoming big news in Australia, we really don't need to provide for superannuation because we keep on ploughing back all the profits into the business. And my superannuation fund is my business. Fast forward to 2018, where it's very difficult to sell businesses. I wonder what some of those businesses feel like today, or the directors or the operators of those businesses feel like. Are they as confident today that they're going to be able to sell their businesses so that they can retire with dignity? Perhaps they've now got some family members, son, daughter, daughter-in-law, father, son-in-law, or even grandchildren working in the business. Now, they mightn't have much money at this stage of their lives, but they have got enthusiasm. And perhaps an answer could be for the company that's been well run and has been trading profitably to raise some external capital so that the founder is able to retire with some dignity. Now, someone said to me the other day, oh, yeah, but the kids would want to buy those shares back. Well, I'm sure they're going to be able to buy the shares back in the next 5 to 10 years, as long as they're offering a good return to these investors who are coming into the company as shareholders. Most of those new shareholders will not want to remain on that particular company's share register forever. They'll be looking for an exit strategy. And that exit strategy may well be the family members buying back the business, buying back the farm. Let's look at a balance sheet review. What's a balance sheet tell us if you review your clients objectively, thinking about the crowdsource funding opportunities? Does the company have loans other than bank loans secured on property that the company owns? In other words, are they using other people's assets as security for borrowings for this business? Do they have other bank or finance company loans? Have they got mum and dad bank loans? I noticed in the financial review yesterday that mum and dad loans to SME businesses are 25% of the total loan funds received by SMEs. That's a very high figure, isn't it? Mum and dad loans. I'm sure mum and dad would like to get their money back. They mightn't really say it to their son or daughter, but I'm sure they would. And one way of facilitating this repayment to them could well be by raising some capital, utilising crowdsource funding, so that the mum and dad loans can be paid out and mum and dad can get on with their lives and possibly their retirement. They may have loans from family and friends, or they've got high credit card debts that they would like to be able to pay out. Would the directors be interested in raising capital to do these things? I'm sure many of them will be. But they will need you to have a discussion with them. Accountants quite proudly wear this badge of the trusted advisor. This is a good test for you to really look at your clients objectively. Not just saying none of our clients will be interested in this. I think you hold the responsibility to do some detective work and identify which of your clients could be interested in this activity and then have a discussion with them. And we are running webinars for business people and telling them to go and talk to their accountants. And if their accountants can't help them, to come back to our site and we will introduce them to accountants who are our subscribers who will be able to help them. And I hope that you will be in that group of accountants. And another area you might look at is someone that's too old, too big for ESIC, early stage innovation companies. I hope you remember the process. They've developed a new product, process, or service. But the first test says that those companies have to be under 3 years of age. Sure, there are some loopholes that could be up to 6 years of age, but that's it. But irrespective of the age, the expenditure in the previous 12 months must be under $1 million, and the income could be over $200,000. Now, these companies may have developed a great new product, process, or service, but because their income's already $2 million and their expenditure is $1.7 million, they're not going to be eligible as an early stage innovation company. But I think they're really the second category after the companies who are wanting to scale up, the second preferred category in this whole approach for crowdsourced funding, equity raising. The companies that have developed some new products, processes, or services that have suddenly realized it's going to cost them a lot of money to commercialize that prototype that they've spent a fair bit of time and money in developing. The government recognizes this. That's why there's a major grant called Accelerating Commercialization. It offers up to $1 million on a 50-50 basis to assist companies to commercialize a new product, process, or service. It costs a lot of money to commercialize, to go from the prototype to a brand new product that's been distributed Australia-wide or even worldwide. So let's look at the capital raising process. The company can raise up to $5 million every 12 months. With those companies, we've just overviewed the concepts, the characteristics. Have you started writing down already who might be interested? But why not do it a bit more scientifically than that? Go through and analyze your clients. And remember, they don't all have to be companies today. If they're currently trading as a partnership or a sole trader and they want to go down this process, roll them into a company then. Our recommendation is you present a seminar to these selected clients, and in the material that we supply to our subscribers, and I'm going to talk to you about a little bit later, we have a full presentation of a seminar available for our subscribers to use. This is an opportunity to create new income streams for your accountancy business. The accounting media is flooded with articles saying accountants need to do more work than just tax returns because tax returns are becoming a commodity type product. This is an opportunity for you to expand and offer a broader range of services. You're on the ground floor at this stage. We've just started to promote this product. We're not under any illusion that this product is something that we're going to market to 10,000 accounting firms in Australia. Once we get about 500 sites under the product package subscriptions, we're withdrawing it from offer because I think that's about the number to suit the potential market in Australia. At this stage, you don't have to worry about the number, but hopefully in the next month or so, that will become an issue because we will have reached our number. So to prepare a crowdsourced funding offer document, there's the potential that other income stream type work has to be undertaken. The CSF offer document's a de facto prospectus. To prepare that, the business will need a business plan, budget, cash flow forecast, a company valuation, share price determination, information memorandum. My estimate on professional fees for this work is $20,000 to $40,000. And some people have told me that's an underestimate. And I suspect it might be in some markets. There's also the real possibility that you might be able to supply a virtual chief financial officer service to this company. because they're all not going to go to the market to raise $5 million. Indeed, I think the average is probably more likely to be $350,000 to $400,000. But they are taking on a responsibility of accessing other people's money. I think it's very important that there is a strong acceptance of accountability, that proper accounting reports are going to be prepared. The directors should be insisting on this, and hopefully these companies will be appointing more than the required 2 directors, and some of those external appointments will be experienced, capable directors who will be insisting on regular, prompt, accurate financial reports covering all aspects of the company's operations, not a profit and loss account and a balance sheet that would be prepared for the annual taxation return. Part of the role and where income can be generated is advising the client on the crowdsourced funding intermediaries role. We're going to talk more about the intermediaries in a short while. But clients need to understand the duties, responsibilities, and powers of the crowdsourced funding intermediaries. As their advisor, you will probably be involved in the determination of which intermediary is going to be appointed to your clients' companies. Let's look at the new law, which started operating since the 19th of October this year, because a proprietary company can now become a crowdsourced funding company. Proprietary companies, as you know, have always had a limit of 50 shareholders. That still applies for the proprietary company area. Employee shareholders do not count in the 50 shareholders, but neither now do crowdsourced funding shareholders. So a proprietary company that's also a crowdsourced funding company has potentially going to have 3 groups of shareholders. Proprietary company shareholders, which could be the original shareholders and money raised under Section 708 of the Corporations Act, which we're going to talk about shortly. Employee shareholders, and then crowdsourced funding shareholders. And separate share registers have to be kept for each. So we end up with something like this. We've got the ordinary shareholders that are counted up to 50, and then employee shareholders and crowdsourced funding shareholders, there's no limit. Some people have been getting concerned that the crowdsourced funding shareholders were going to be part of the 50. That's not the case. That's what the legislation said when it was first submitted, or the bill was first submitted to Parliament, but wise heads soon had that changed because there was no way 50 shareholders limit was going to be enough if companies could raise up to $5 million from retail investors. I mentioned proprietary company capital raising from Section 708 a little earlier. This still applies, and a company can do both. So the company could utilize Section 708 to raise some money, and if they're from sophisticated investors, their contributions don't count towards the limit that we're going to of $5 million. So under Section 708, from retail investors, the company can raise up to $2 million in a 12-month period from no more than 20 investors. Those 20 investors are part of the 50 shareholder limit for a proprietary company. So let's look at a quick overview of the crowdsourced funding legislation. An offer can only be made by the platform, is what the legislation refers to it as. In other words, the website of an appointed crowdsourced funding intermediary. The intermediary, and there are 7 of them in Australia, appointed by ASIC, must hold an Australian Financial Services licence with an express authorisation to be providing the crowdsourced funding service. To make a crowdsourced funding offer, the company must publish a tailored crowdsourced funding offer document. In other words, it's not just a template that's the same as everyone else's. It's one that suits the company, and the directors must have selected one out of the 7 crowdsourced funding intermediaries and signed an agreement with them, and all applications and applications monies are to be processed via the intermediary's website. In other words, if the chairman of directors has got a favourite aunt and she wants to invest $100, she cannot give the director the $100 to finalise the transaction for her. The legislation requires that all potential investors must undertake their dealings via the intermediary's website. And that's primarily to enable the intermediary to make sure that the investment warning has been conveyed to the potential investor. And all offers must be closed within 3 months, if not closed earlier. So this offer's not going to sit there for 6 months or 7 or 8 months. 3 months is the absolute limit. A retail investor, who is obviously anyone who has not declared themselves to be a sophisticated investor with the required documentation from their accountant, is limited to a maximum investment of $10,000 in a 12-month period per company. Excuse me. And the other big requirement is that retail investor has an unconditional right to withdraw from the offer within 5 business days of making an application. So it is true that a competitor could go onto the website and read the company's offer document and then say that they've changed their mind and want their subscription back. Unfortunately, there's nothing that can be done about that. And the government was well aware of that because it was brought to their attention by a few people. The company is not required to appoint an auditor until the company has raised more than $3 million on a cumulative basis from crowdsourced funding or from other capital raising from retail investors, such as a Section 708 capital raising solely from retail investors. Let's now look at the crowdsourced funding intermediaries. Intermediary is a financial services licensee who's been issued a special license by ASIC. The then Treasurer, now Prime Minister, when he introduced this legislation, originally referred to the intermediaries as the gatekeepers because they have to check various documents. They have to maintain a communication channel once the offer document is listed on their website and coordinate with the directors and senior management to ensure that there is a response every day to any questions that have been raised by potential investors. The intermediary is able, in accordance with the legislation, to negotiate their fee with the company's directors. The fee could be in a cash payment, or it could be part cash and part shares, or all shares. But whatever the deal is, it has to be fully disclosed in the offer document and on the intermediary's website. Let's look at the opportunities for accountants. You've got an opportunity to be involved in a high-value service for your clients. It's a new revenue line that is a high margin. It's strategic work. It's work that your team members will find very interesting. It will add value to your clients. It will help increase loyalty. You will be growing with your clients. As I indicated at the beginning of this discussion today, I believe that the vast majority of companies which will be seeking to raise crowdsourced funding, equity raising capital, will currently be the clients of small to medium-sized accountancy firms. So let's look at the potential services and indicative fees. Advice on the operations of crowdsourced funding, the eligibility, the intermediary's role, etc., $5,000 to $10,000. Preparation of a business plan. If the client does not already have an acceptable one, $10,000 to $30,000. Preparation of budgets and cash flow forecasts, $3,000 to $10,000. Undertaking some mentoring of your clients on the corporate governance requirements, $2,000 to $10,000. Preparation of the crowdsourced funding offer document, $5,000 to $20,000. Virtual Chief Financial Officer services, $10,000 to $125,000. Fair bit of work there. Let's look at what Enable Funding, who are the owners of the oldest crowdfunding type platform in Australia, which was originally known as ASOB, Australian Small Scale Offer Board. This entity was founded in 2007. They've raised $148 million for 176 companies. They have 30,330 exclusive members. This is Enable Funding, and you can check that out on their website. These are potential investors. And each of the other intermediaries will have similar statistics. Some of them might be counting people who have registered as investors with some of the other intermediaries as well, of course, but there's a significant market there. Let's look at the forecasts that Enable Funding have made. They believe that the capital raising in 2016 was about 119 million, 17 was 210. They expect that this current year will be about 420 million. It might be a bit lower than that because it's taken a lot longer than what they would have thought for this legislation to be operational. A lot of people thought it would be operational by about March 2018, whereas it's virtually November 2018 before anything got started. 2019, though, it is forecast to jump to 688 million, 20 to just over $1 billion, and 21 to $1.5 billion. That's a fair amount of money, and it's a significant growth, tenfold in just 5 years. Why wouldn't you plan to create a new income stream out of this new market for your accountancy firm? I think it's a great opportunity. So in summary, crowdsourced funding is a great opportunity for some of your clients to go to the next level. And it also creates a great new revenue stream for proactive accountants, which will also assist your team to be doing interesting, real accountants' work. I'd now like to give you a brief overview of what the ESS BIZTOOLS equity raising product package has in it. We start with Section A, the preparation. This is really the training area for you and your team. A video on how crowdsourced funding operates, a paper we've written, and there's a webinar we've prepared, which will guide you through the process. And we have a webinar that we've prepared for clients. Our recommendation is that you re-prepare that webinar yourselves and place it on your website to attract clients to your firm. Section B is the marketing material. It's very important that accountants realize that in this new age of looking at the opportunity to generate new fees, that accountants need to be conscious of the need to market. So we have a crowdsourced funding eligibility matrix that identifies 14 key areas, 5 of the legal, and then 9 others that clients might be involved in. We've got a seminar or webinar prepared, Do You Need Funding? We have an article for your website, Crowdsourced Funding, 21st Century Way to Raise Capital. We've got a news release that you can send to your local media. SMEs can now crowdfund. We've got an article to send to your clients and prospects. Crowdsource funding equity raising explained. Does that help you? You get that if you subscribe to the ESS BizTools package. Section C is the quotation and proposal. There are templates there for you to use if you wish. Section D is crowdsource funding overview. This is background articles for your team as part of the team training, but also some of those articles you can hand on to your clients and prospects so that they understand all about crowdsource funding. I think it's very important for you to be assisting in educating your clients as to how this whole process works. And then I think you might be surprised about the number of people that come and talk to you. The government really believes that this is going to be an effective way of assisting smaller businesses and medium-sized businesses to raise some capital. The Section E is the corporate governance concessions. That only applies for companies that are registered prior to the 19th of October when the new legislation started. Now let's look at what you have got, what the tools are available to assist you to guide your clients on the crowdsource funding equity raising journey. So we've broken it into 12 steps. Step 1, is your client potentially eligible to be a crowdsource funding company? We have a checklist and a couple of other items which will assist you to identify those clients. Is the company interested? Obviously, even though they fit the criteria, if they're not interested, well, move on to the next client or prospect. What's the level of disclosure? Is your client comfortable with the level of disclosure? There's a lot of disclosure required, and if anyone's ever had a problem with the Australian Security Investment Commission, unfortunately, they're going to have to disclose that if they are a director or senior manager of that company. Doesn't say anything about shareholders. So your client needs to understand that and be comfortable with that. Or perhaps some other strategies need to be implemented. Step 4 looks at the investor categories and make sure that everyone understands the rules applicable to retail investors. Step 5 is the role of the intermediary. I believe this is very important, that your client clearly understands what this organization called the intermediary is all about, what their powers are, what their responsibilities are, and what their duties are. And then we move into the contact with the intermediary. Our recommendation is that you would advise your client to have a discussion via in person or via Skype or by telephone with the intermediary, so you get a feel for how enthusiastic they might be for your client's business, how hard they're going to work to promote it. Are they going to distribute an email to 30,330, their entire database of prospects for investment, to tell them about the company? Then you move into preparing the crowdsource funding offer document. That's a detailed process, and we have developed a number of forms and procedure notes to guide you through that process. Step 8, the crowdsource funding document, when it is completed, then has to be officially submitted to the intermediary, and there's some steps in that process. Step 9, going live on the intermediary's platform. This is the exciting part. Your clients can send a letter to their team, their staff, their suppliers, their customers, and other people that they're dealing with on their day-to-day business activities, might be contractors, subcontractors, to tell them that they can now visit the website to have a look at what's on offer. There is a step which we refer to as the crowdsource funding equity raising offer document defective. The legislation sets out processes that have to be implemented if it is found that one of the statements is incorrect, so it becomes a defective statement, and the company must then ensure that a corrected document is released very promptly. Step 11 looks at what happens when the crowdsourced funding offer is closed at the end of the 3 months or an earlier period if the declared maximum subscription has already been raised. And then we look at the step 12, the post-capital raising. What happens? Well, the first thing is that share certificates have to be issued to the new shareholders in the company. I think the company's chair should be writing a letter of welcome to those new shareholders and telling them how often the CEO or the chair is going to communicate with them every 3 months, every 6 months. And then the return of allotment of shares for the crowdsourced funding shares has to be lodged with ASIC. And obviously then the company gets on with life. Someone has asked me in another webinar, what's the ongoing role of the intermediary? There is none. The intermediary has then finished their appointment with your client's company. They have to make a submission to ASIC to tell them what happened. And they just concentrate then on the next company that wishes to utilize their services to raise capital. Your investment in this product, the crowdsourced funding package, is $999, including GST. That gives you 24/7 access per office. Or you could subscribe to the ESS BIZTOOLS Gold package, which includes the crowdsourced funding package and 22 other product packages and a wide range of other services that you can view if you go to www.essbiztools.com.au. You can apply for a guest login so you can have a good look at the system. But your subscription is normally $2,970, including GST. Or, as I hope you know, we have a Black Friday promotion, which is running until the 3rd of December, and it has a 40% discount. So if you are able to subscribe before close of business on the 3rd of December, your subscription to receive this package, which will give you an intro into a whole range of new types of services for your clients, is $599, including GST, or you can subscribe to the ESS BIZTOOLS Gold package for $1,782, including GST. If you wish to subscribe before close of business on the 3rd of December, please insert the codes for crowdsourced funding equity raising on its own, CSFBF40, and for the gold package, Gold BF40. And you will then get the benefit of the discount, and that expires on the 3rd of December. If you would like to talk to me about any aspect of ESS BIZTOOLS, crowdsourced funding products, please give me a ring, 4724 118 or 0418 190 181, or send me an email, peter@essbiztools.com.au. You can check out our website at www.essbiztools.com.au, and as I said earlier, you could apply for a guest login. And we also have a government grant program which will assist you to identify grants that your individual clients might be eligible for. Then we have papers on each of those grants so that you're able to submit a report which we prepare in our system for you to send to your clients. And that website is www.essbizgrants.com.au. I'm going to see if I've got any questions. There's no questions. If you think of a question later on that you would like to ask me, why not send me an email, peter@essbiztools.com.au. I look forward to you joining us as a subscriber member of ESS BizTools for the crowdsource funding offer package, or as a gold subscriber to ESS BizTools, where you have a range of products and services which will assist you to operate a very commercial service for the benefit of your clients and your team members. Thanks for joining us today. Have a great day. Goodbye.